Hi, this is Crooks for Money and Markets TV. It's clear to me that the unchecked money printing by global central banks is hazardous to our long-term financial health. But in the shorter term, all this easy money has sparked a major rally for stocks and other risk assets. Last week, Federal Reserve Chairman Ben Bernanke said that the central bank would take additional action to spur economic growth if the recovery in the employment picture begins to falter. If the Fed steps back in with more quantitative easing, that would be an overall bullish force for the markets. In other words, bad news for the economy means good news for stocks. But conversely, good news for the economy does not mean bad news for stocks. Improvement in the economy might alter the current speculative nature of the markets, but economic growth is ultimately bullish. So it seems that this is a win-win scenario for stocks. This is exactly what the central banks wanted. It's as if they can do no wrong. Take the ECB, for instance. Its latest scheme flooded European banks with billions of euros of cheap loans. That money has been used to make speculative bets in the markets, rather than making its way into the real economy in the form of loans to businesses and households. This lack of credit in the real economy is clearly a problem, but investors are ignoring it. They continue to buy risk assets as long as they see the central bank doing something, even if it isn't working as intended. If you asked me to develop a scenario in which the markets perform poorly, I'd say one of two things would have to happen. One, investors would have to become truly worried about unsustainable levels of debt. The unsustainable debt in the Eurozone is old news by now, and it hasn't fazed investors. So it would have to happen elsewhere, most likely the United States or China. As you can see, central banks all over the world are over-leveraged, and overall, global debt is outpacing global growth by a wide margin. Nearly 10 to 1. But it would take more recognition of this fact by the public to put a stigma on further monetary easing, rendering it ineffective. The second event that could cause the stock markets to reverse their recent gains would be a blow-up in global derivatives. After all, this is exactly what caused the financial crisis in 2008, and not much has changed since then. According to the Bank of International Settlements, global derivatives rose to a record $707 trillion in the first half of 2011. And U.S. banks have $641 billion in loan exposure to periphery Eurozone nations like Greece, Portugal, and Spain. But barring one of these two events, I'm betting the stock market will keep on defying gravity as long as continued accommodation from central banks remains on the table. Investors are unlikely to start fleeing risk assets in a significant and lasting way. So when you see some softness across the markets like we did last week, it probably amounts to nothing more but a buying opportunity. I'm Crooks for Money and Markets TV. Thanks for watching.